The HELOC trap. How homeowners lose everything. Imagine this. You owe $25,000 on credit cards. The interest rates are crushing you. Then someone tells you about a HELOC. Just use your home's equity. Lower your payment. Save thousands in interest. Sounds brilliant. But what if I told you that the same loan that can save you thousands could also put your house at risk? And the biggest danger isn't the interest rate. It's what most people do after they get the money. Today we're talking about HELOCs, the good, the bad, and the mistakes that can turn a financial tool into a financial disaster. And stick around because later I'll show you the single biggest HELOC mistake homeowners make. What is a HELOC? A HELOC stands for Home Equity Line of Credit. It is a revolving line of credit secured by your home, allowing you to borrow money against your home's equity. Another way to view it is, think of your home like a giant piggy bank. Every mortgage payment you make builds equity. Let's say your home is worth $500,000. You owe $300,000. That leaves roughly $200,000 in equity. A lender may allow you to borrow against part of that equity. But here's what makes a HELOC different. You don't receive one giant check. Instead, the bank gives you access to a line of credit. Similar to a credit card, use it, pay it down, use it again. Sounds convenient, right? That's exactly why so many people get into trouble. Why people love HELOCs. Reason number one, lower interest rates. Because your home secures the loan, lenders generally offer lower rates than credit cards. If you're paying 25% on a credit card and can borrow at a much lower rate, that can save a significant amount of money. Reason number two, home improvements. This is one of the best uses of a HELOC. Why? Because you're borrowing money to improve an asset that may increase in value. A remodeled kitchen, a new roof, updated bathrooms, finished basement. These projects can improve both your quality of life and your home's value. Reason number three, flexibility. Unlike a traditional loan, you only borrow what you need. If you have a $100,000 line of credit and only use $15,000, you're generally only paying interest on the amount borrowed. The part nobody talks about. Now let's talk about the danger. A HELOC creates a psychological trap because the money feels easy. It feels like your money. It feels different from taking out a loan. But it's not. It's borrowed money. And many homeowners start using their house like an ATM, vacation, HELOC, new furniture, HELOC, luxury purchases, HELOC. The problem is that temporary purchases can create long-term debt. The biggest HELOC mistake. Remember the homeowner with $25,000 in credit card debt? Here's what often happens. They use a HELOC to pay off the cards. The cards go to zero. They feel relieved, problem solved. Except 6 months later, the credit cards are full again. Now they have $25,000 on credit cards, plus $25,000 on the HELOC. And here's the scary part. The credit card companies couldn't take their house. The HELOC lender can. This is how unsecured debt becomes debt backed by your home. And it happens every day. The other risk most people ignore. Many HELOCs have variable interest rates. That means the payment can change. Imagine borrowing when rates are low. Everything looks affordable, then rates rise. Suddenly your payment jumps. The balance hasn't changed, but the payment has. Many homeowners never plan for this scenario. Who should use a HELOC? A HELOC can make sense if you have substantial equity, you have stable income, you have a clear purpose, you have a repayment plan, and the money is being used to improve your financial position. Examples include home improvements, strategic debt consolidation, certain business opportunities, emergency liquidity. Notice what isn't on that list: vacations, luxury purchases, lifestyle upgrades. Who should avoid a HELOC? You should be very careful with a HELOC if you struggle with spending, you live paycheck to paycheck, you have unstable income, you don't have a repayment plan, or you're simply looking for extra money. Because a HELOC doesn't create wealth. It simply gives you access to equity you've already built. Final lesson. A HELOC is not good. A HELOC is not bad. It's a tool. A hammer can build a house, or it can smash your fingers. The difference is how it's used. The rule I want you to remember is simple. Use a HELOC to build value. Never use a HELOC to fund a lifestyle. Because when you borrow against your house, you're not just risking money. You're risking the roof over your head. If you found value in today's video, subscribe to Road to Wealth. My goal is to help you avoid expensive financial mistakes and build lasting wealth one step at a time. And let me know in the comments. Would you ever use a HELOC? And if so, what would you use it for? Until next time, keep building your road to wealth.